Welcome everybody to this month's actually, Elevánt Insights. My name's Dan King. I'm joined again with my co-host, Brian Scott. He's back from meetings he was at last month. We're excited to have Mike Arone, and we'll have Brian introduce him in just a few minutes. Also want to make sure that we cover just a few things that we normally do as far as housekeeping items. If you do have a question, you can go into the chat mode and do that or raise your hand, and we'll try and get that to you. Today's episode will be pretty much in a discussion type of scenario as we go through and ask Mike Arone from State Street some questions. So one thing we try to do is just give you a little bit of insight on what's going on, and what we call the Elevánt Insights, just a quick moment or two. And I just found some real short, brief comments that I thought would be interesting and just kind of a easy reminder for you on things to do. And so I think I got 7 of these. The first one, borrowing for something that loses value is bad. So don't buy lots of cars on loan, I guess, or anything else for that matter. Borrowing the cheapest money you can. Then the second thing. Third thing, don't let monthly payments tempt you on bad ideas. So don't get caught up in just because the monthly payment's low, buying all sorts of different things. I love this next one. Save, save, save. The next one, don't prepay your mortgage when you have that monster car loan. So, if you got a large car loan, and you're trying to pay off the house, you might focus on what has the highest interest rate first. The next, all those junk mail loans deals are really from bad actors, so stay away from those things. I stole that from someplace on the internet, those things. I just wanted to add a couple more as we see things that are real important to our clients here at Elevánt Insights. That would be to make sure your financial documents are up to date, or that you have them in place, i.e. the wills and trusts, healthcare directives, and POAs. Make sure that's taken care of, and that you're in good shape that way. And finally, make sure this summer that you have fun. You've worked hard for that money, but time with family and others is really what it's all about, to enjoy your time. So please make sure that you have fun. And with that, I'll turn it over to Brian for an introduction of Mike Arone.
Great. Thanks, Dan. So we are very excited to have Mike Arone back on the webinar. Appreciate his time. Mike, as you might remember, is the Chief Investment Strategist for the 4th largest money manager in the world, State Street Global Advisors. He's really responsible for expanding State Street Global's footprint and thought leadership through regular contributions to the financial news media, speaking engagements, client interactions, things like that. And so if you watch enough CNBC or whatever else you watch, Fox News, who knows, Mike's face there from time to time. So we're honored to have him here. His thought leadership and perspective and really representing the research behind State Street is super valuable and very helpful as we kind of develop our thoughts towards what's happening in the markets. And so essentially, Mike, we kind of want to just turn the time over to you, kind of talk through a little bit about where you're seeing things are, where things are from your perspective, and what we'll do is kind of interject with some questions. We want to keep this real casual today. So without any further delay, Mike Arone.
Great. Thanks, Dan, and thanks, Brian, and thank you for inviting me back to participate. It's always a lot of fun. In Dan's opening comments, the 2 things that stood out to me was save, save, save. I can't emphasize that enough. It's the key to financial success, and ultimately also the have fun bit. So I happen to be joining you from my home in Cape Cod, Massachusetts. So I'm looking forward, perhaps like many of the fathers out there, to a nice Father's Day weekend, maybe watch a little bit of the US Open and play some golf, go to the beach or something. So please have fun this summer. In terms of markets, it's a funny thing. Investors continue to be obsessed with when will the Federal Reserve cut rates and by how many times. And yet, while they've been laser focused and obsessed with those items, something interesting's happened. The soft landing actually happened. And it may not sound like much, but there's only been 4 of them since World War II, and there hasn't been one in 30 years. So why do I believe one has occurred? Well, the economy is expanding, not contracting, but at a slower rate. So it grew at an annualized rate of 3.9% in the third quarter of last year. It's growing more like 2 to 3% today. So that's good news. That's kind of what the Fed wanted. They don't want it growing too quickly. They want it to grow. They don't want it to be in recession, but they wanted it to cool a little bit. Good news. Labor market's in good shape. Item number 2. So we still are adding jobs. Unemployment has ticked up some, but remains low. Jobless claims remain low, so businesses are reluctant to lay off qualified skilled laborers, and wages are still growing. Good stuff. Inflation, we got that this week. Markets have been hitting all-time highs, S&P and NASDAQ. It's back on the trajectory of lower, not higher. That's good news. Yes, the Fed isn't satisfied just yet, but inflation is trending lower, not higher. Good news for the soft landing story. As long as consumers are gainfully employed, they're going to spend. Yes, they're spending at a slower rate than they were previously, but as long as they're employed, they'll continue to spend. And then ultimately, we just went through earnings season. Earnings are growing. Almost 80% of the companies are beating their earnings, and profit margins are very, very healthy. All of this suggests to me that the soft landing has happened. Now, I don't approach this, and I'll finish this quickly, Dan and Brian, and then we can kind of engage in conversation. So I think what's interesting is that a lot of this is already reflected in markets. So many markets around the world, including the S&P and the NASDAQ, are at all-time highs or near all-time highs. One of the things that we think about are credit spreads, or kind of how much over treasuries do you have to pay. So credit spreads are very tight, which is an indication of kind of folks' complacency or comfort level. And measures of volatility in the markets are actually quite low. So this suggests to me that much of what I just described to you, the good news, is already reflected in prices. So we're a little concerned going forward that the risk may be skewed to the downside. And I think in a minute, I'll just list the risks, and then I think Dan and Brian and I will get into a conversation about kind of delving a little bit deeper. But I think the risk of a monetary policy mistake is rising. Likely the Fed will remain too tight for too long and put us in unwanted recession. That's a potential risk. We could topple over the US fiscal cliff. Government spending has been at a breakneck pace, even though the economy is growing. That's a risk going forward. Inflation, although we've made considerable progress, is still sticky. So we could talk a little bit about that. Earnings are expected to accelerate next year. This is number 4. So what happens if we don't meet those growing earnings expectations, particularly when valuations are stretched? That could be a risk. 40% of the world's population is eligible to vote this year. Some of that's already occurred. You may be reading headlines about India and Mexico, Europe over the weekend, and of course, the granddaddy of them all in November, the US presidential election. So again, this won't do much for kind of the direction of markets overall, but it creates some headline risks going forward. Certainly you have some geopolitical risks as well. That's in the headlines, but markets have mostly ignored it. But these kind of 5 or 6 things, I think, skew risk to the downside. I'll finally conclude on this. Take a deep breath, sigh of relief. On balance, given the fact that the market has done so well through the first half of this year, it would be surprising if the market didn't finish the year positively, meaning with a good overall return. And many times we get a post-election rally. Again, whether it's Trump, whether it's Biden, whether it's somebody else, historically, once we get an election outcome and a transfer of power, markets typically rally because an uncertainty has been removed. And it's also a seasonably favorable time of the year. So given this, I expect 2024 to be a pretty good year for portfolios, broadly speaking. Finally, since 1952, every single election year with an incumbent running, regardless of whether they win or not, stock markets have been up. So far this year, it looks like that trend will continue, or that record will continue. Oftentimes what happens is monetary policy and fiscal policy are favorable headed into the election. They want to be reelected. They want you to be happy when you go to the polls. So there's usually some fiscal stimulus and some monetary stimulus to support the economy as we head into the election. That is also the case today. So overall soft landing outcome, I think, has been realized. It is reflected in prices and valuations. The risks are skewed to the downside, but on balance, I think this year should be okay. I'm a little more worried about next year. So Brian, Dan, let's chat some more about markets.
Brian, you're muted, buddy.
There we go. Can you hear me now? So I think what first comes to my mind when we hear something like this, whether it be on the financial news media or in a webinar like this, is oftentimes we get knee-jerk, what should I do reactions? Like, well, from what I heard, I should stay in the market until December and then sell everything because next year's going to be bad. And so I guess maybe speak a little bit relatively regarding these general risks, because when I hear these risks, none of these sounds to me like, major 2008, 2009, the system's broken, we're going to see a major collapse, more of just, natural bear market, every 6 to 8 years, we're going to see these cycles play themselves out. And so maybe just talk to the degree of the downside risk that you're mentioning.
Right. I think that's kind of a somewhat normal or some more typical risks that are kind of out there. They're identified, they're kind of well-defined. And so as a result, they shouldn't cause too much in the way of volatility or problems in the markets. And again, my crystal ball is just as murky as everyone else's. So
Sure.
Everyone listening today has worked diligently to create and worked with you all to create a goals-based financial plan over a long time horizon. And ultimately, that investment policy statement and that goals-based financial plan is the key to kind of keeping your eye on the prize. Sorry, that's a bad one, a bad kind of cliche, but ultimately, I wouldn't overreact or underreact to any particular news items. What I'm just suggesting is that today, many markets are at or near all-time highs. As it relates to kind of fixed income markets, there, again, credit spreads, just a measure of riskiness, are also very complacent, are very tight, and most measures of market volatility are low. So the way I just think of this is kind of when we say the risks are skewed to the downside, it just means that all these things are at historically kind of peak levels. They probably won't stay there for long. Something's going to happen to alter them, but it's nothing that's ominous or can't be absorbed in a long-term time horizon with a disciplined kind of goals-based financial plan. So I wouldn't over or underreact to any of these things. I guess what I want to prepare listeners for is, boy, the market was up, S&P was up more than 26% last year. That's the S&P, not a diversified portfolio, but the S&P was up 26% last year. It's up here again about 13% this year. I just want folks, hey, trees don't grow to the sky. There's probably going to be some valleys here as well. But overall, I think you're going to end in a really good place.
Mike, let me just kind of maybe continue on that a little bit. As our clients are looking through all the news and all those things that are out there, is there a general rule of thumb as far as where they could go or how to really look at the information that they receive and how to digest? I mean, how much of this is crazy doomsday type of stuff, and how much is really valid, and how do they? I mean, obviously we're part of that decision discussion, but there's so much out there right now. It'd be nice to kind of have a guideline, and maybe you'd have it, maybe you don't.
Yeah, so I highly suggest turning off the TV, particularly, again, whether it's MSNBC, CNN, Fox News, whatever your favorite is, or your least favorite, turn them off. It's entertainment. It's intended to get your anxiety up. It's intended to get you angry. A lot of what you do on the computer is also algorithm-based, and it's trying to get you anxious and get you angry and feeling unsettled. So in many ways, I think one of my bigger takeaways is to largely ignore the noise it's easy to get trapped in that. Also, what we find, at least in financial studies and things historically, is investors who are checking their statements and their values and their portfolio more frequently than others tend to do less well, because they want to react, they want to make changes, they want to do something, they want to, they want to feel compelled to do something, when often the best course of action is to stay the course. And so ultimately, our view is, again, I try to not, investors should, not get overly emotional relative to things. There's a great book by a guy named Matt Taibbi. I think it's Taibbi. It's called Hate Inc. And ultimately, it's interesting. So Matt Taibbi was famous for writing. He was writing for Rolling Stone at the time, and he wrote the famous line about Goldman Sachs being the giant vampire sucking squid. And that obviously got a lot of clickbait and all that. So he writes this book, and he talks a lot about how the media, and again, that would include Fox News as well as CNN, MSNBC, etc., kind of how much of it is entertainment, how much of it is intended to make you angry, to get your anxiousness out, to unsettle you, to keep you coming back. And ultimately, it's not objective, kind of real news-based information. So that's hard to come by these days. And so the key here, I think, is to read lots of different things and come up with your own objective opinion, and just keep mindful of what is the angle here. What is, what is the angle from this place or that place, from that standpoint. But that book is kind of interesting, fascinating, pretty short. And I happen to enjoy it. So if listeners want to grab it, it's an interesting one. And I think it's fairly balanced. It's objective. Yeah. It's not, some crazy progressive thing or some super conservative thing.
Yeah. It's interesting too. You hit the nail on the head, from our perspective as financial planners, our goal is the success of our clients individually, right? And everybody's plan's a little bit different. And so, some of our clients were implementing a bucket strategy where we have a long-term bucket that's invested possibly a little bit more aggressively with short-term and mid-term money that's more protected. And so I think, with the markets being doing really well in the last year, what a great opportunity to revisit your financial plan, double check to make sure that we're prepared for our short-term and mid-term needs in reference to where our money's invested and how it's invested, to make sure that no matter what happens coming forward, that we're taking advantage of the markets, good and bad, to set our money aside for what we actually need it for. If you've sat with me long enough, you've heard me say this, but there's only two things we're ever going to do with our money. We're either going to save it, we're either going to spend it, or we're going to give it away. And so if we can focus on those two goals, and how do we want to spend our money efficiently, and how do we want to give away our money intentionally, then the noise of the markets we can use to our advantage, and put them in their proper place as we execute on those two goals. And so
So Brian, let me, if you don't mind, kind of, again, I feel like, not that we're dancing around this, but so again, if it's coming from me, it may sound even strange, and Dan kind of touched on it in his opening comments as well. So sometimes folks will ask me, well, what are the keys? Well, the key to financial success is having that goals-based kind of financial plan, that investment policy statement with that long-term time horizon. Diversification certainly is a component of that. Save, just like Dan said up front. Keeping taxes to a minimum. Doesn't mean sometimes you have to pay taxes. I hate it too, but sometimes you have to pay taxes, but keeping them kind of minimal and keeping cost reasonable. And again, it doesn't always mean the cheapest item out there, but keep cost reasonable. You do those things, it doesn't matter much whether you picked the right stock or growth or value or large cap or small cap or international or whatnot. If you do those other things and you do them well, and you essentially, when volatility is high, if you have courage, capital, and conviction and put some money to work, that's often a good result. And when you don't overreact when things are negative and kind of go to all cash or, get me out of this, that type of thing, and weather the storms. Those are the keys to success. The reason why I say it's strange for me is because I do spend a lot of time with clients and investors saying, Hey, we like US stocks, we like this. But at the end of the day, when your clients retire or they're kind of at the end of kind of this thing, ultimately, whether they had a little more growth or value or small cap or large cap or bonds or stocks won't matter all that much. Those other things matter more, much more.
So one other question for you, say we've got more of a conservative investor who's feeling the growth of the stock market over the last couple of years and wanting to possibly go a little bit more conservative. Let's shift the focus a little bit to bonds and just fixed income in general, because we know interest rates on bonds and CDs and treasuries are pretty lucrative right now for the average investor. And, you know, where they're getting 4 and 5% out of money markets and CDs and treasuries and bonds. And then, as we know, that if interest rates go down, bond prices go up. And so we could kind of milk the interest rates as long as we can, but actually get some appreciation in our bond prices. I'm curious your thoughts on fixed income coming into the end of this year and next.
Right. So it's interesting. I think that fixed income continues to be one of the biggest challenges for investors. And so, as you pointed out, kind of for much of this century, interest rates have been incredibly low, and in some instances negative. At one point, we had $18 trillion in negative yielding debt globally. Didn't happen here in the U.S. with U.S. treasuries or anything, but we hit that height. So I would have to pay the government of Germany for the privilege for me to lend them money. That exists in no textbook anywhere. So it pushed a lot of investors, particularly retirees and savers that needed income, to think about things like loans, private credit, high yield bonds, kind of a little bit more of the riskier parts of the fixed income market. Now, good news. Today, with rates higher, investors can invest in money market funds, treasury bills, short-term treasuries, certificates of deposit, and perhaps some demand deposits, and capture about a 5% yield, give or take a little bit. With inflation where it's at, and again, it came in this week, the CPI, all items came in at 3.3%. It's in the middle of June for those listening. Ultimately, that yield is above the rate of inflation. So my purchasing power is maintained. And investors have been waiting so long to get it, they're really reluctant to do much of anything else. But Brian, you point out rightfully that if rates fall, and those are all short demand or short maturity investments, when it comes time to reinvest those proceeds, they might have to do so at lower rates. And that is a risk that we call reinvestment risk. So we are kind of seeing most or many investors barbell, meaning they still have those comfortable shorter duration investments, money market-like investments that are paying them 5% with lots of liquidity, very little interest rate risk, very little credit risk, and they're happy as can be to collect that. But they're also barbelling that with some longer maturity things in case rates do in fact fall. And many market prognosticators are expecting that as the economy cools, and I mentioned it has been cooling, as inflation falls, as I mentioned, trajectory, it's been falling a little bit. And then ultimately, that the Fed would begin cutting rates, that rates will fall. And when rates fall, bond prices go up. So they're barbelling that with some longer maturity items. So one of the things that has happened is that long maturity, kind of 20 plus year maturity investments, like 20 plus year treasuries, it has been an absolutely wild ride in terms of price volatility. It's almost been as or equally as volatile as stocks, and I think that surprises many. So one of the things we kind of encourage investors to think about is maybe moving to what we call the intermediate part of the curve, kind of somewhere in that 3 to 10-ish range, kind of that 4 or 5-ish range in maturities. And why we say that is because your yield is similar to what you're getting on your shorter duration investments, those money market funds. So you don't have to give up much there. Good news, right? That makes me happy. I am extending maturity some, so that's good. So if yields fall, I'll see price improvement. And I'm not taking on as much risk if I was really kind of lengthening maturity way out into the future and kind of 20 plus years. So that seems like the sweet spot for us for many. So things like intermediate investment grade corporate bonds, we feel like aren't too risky and help you achieve a few things on the yield and the duration profile or the interest rate profile.
Mike, as you were are talking about some of these asset classes, kind of comes to my mind, are there anything that's different in today's world in the relationship to diversification? Do we still fall into the category of modern portfolio theory? I mean, maybe just let's use the word of diversification. And how do we go about that in relationship to those time horizons with those clients?
Right. I think that, again, diversification is one of the key ingredients to long-term success, as we talked about, alongside save, 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 keep costs reasonable, keep taxes reasonable, and having a plan. Those are all key ingredients to success. Now, one of the things I do think, so again, I think that the basic elements of diversification and having a diversified portfolio of stocks and bonds still makes tremendous sense. So we're not throwing that proverbial baby out with the bathwater. As you all tell, I get paid by the cliche. So I think for me, I think one of the things that's kind of interesting, though, at the margins, things have changed perhaps a little bit. So let me just share with you quickly, if I can. So I have been in this business for just shy of 30, about 30 years, a buy-side asset management industry. I view that as a short amount of time, by the way. And I'm still curious and learn every single day. So it's not intended to suggest, hey, I know everything. It's just intended to give us kind of, okay, how long has this guy been doing this? What's the time period? So really, for the last 40 years or so, the market has had these two structural things that have really benefited it. One is there's been a peacetime dividend between the world's economic superpowers. So again, to date myself, and I'm kind of squarely in the middle here, I'm 50 years old, so I don't consider myself young or old per se. But when I was in high school, the Berlin Wall fell, the Soviet Union broke apart, that type of thing. From that time forward, it was a peacetime dividend reasonably. Yes, there was wars, skirmishes, tensions, etc. But we didn't have the Cold War type of thing that we did have. That's beginning to shift a little. So we're moving from a unipolar world where the U.S. dominates to what folks call a multipolar world. All right. So whether it's Biden or Trump, whether you hate them, you love them, love one or hate the other, both have more of an America's first type of agenda. And we saw that with the withdrawal of Afghanistan. Now, again, whether you agree with it, you disagree with it, it's a nightmare. But I'm not suggesting that. So what's happening, though, is Iran, China, Russia are stepping in to test the U.S.'s resolve. And it's increasing geopolitical tension. So we see it in Russia, Ukraine, see it in the Middle East, and we certainly see it with China. So I think that this is a structural change that could induce some geopolitical volatility. The second major structural thing that's happened is the kind of admittance of China and Taiwan to the World Trade Organization. So globalization. So both the peacetime dividend and globalization served to stabilize interest rates. They had been mostly falling. And as Brian points out, that means bonds had been mostly rising for almost 40 years. And inflation was very low. So in the decade prior to the pandemic, inflation in the United States averaged less than 2%, 1.8%. So all those things structurally served that. Under that, Dan, to your question, stocks, bonds, and a traditional 60-40 portfolio did awesome, exceptionally well. All I'm saying is that there is a case perhaps to be made that if the peacetime dividend is under stress and inflation's likely to be higher as we enter deglobalization and not globalization, if rates and inflation are a little higher than normal, at the margin, there may be some things that would be better included in a diversified portfolio. It still fits within the framework of diversification. And so my view is, look at the last few years, traditional bonds haven't performed as well because rates have been going up and bond prices have been going down. So stocks are a good hedge against inflation, but bonds are not. And so that's proven kind of this time again. So we think adding a small amount of real assets into a diversified portfolio might make some sense. But I would put that in the broad umbrella of diversification. So I don't think we're abandoning those principles. So somewhere in the 5 to 10% range, funded from cash or equally from stocks and bonds. And what are real assets? Commodities, natural resources, real estate, all fit, precious metals, gold, things like that, all fit within that framework. They tend to work well in a higher inflationary environment and one in which is kind of pockmarked by a little more geopolitical uncertainty. And so we're not saying abandon bonds by any stretch of the imagination or diversification. All we're saying is that having a smaller or an increased percentage of real assets might help in a diversified portfolio if, in fact, rates and inflation are going to be a little bit higher compared to where they have been. I don't anticipate that we're headed back to the 1970s, inflation or interest rates of the early 1980s, not at all. But we are coming off a period of incredibly low rates and benign inflation. So there could be a risk that we're headed towards something a little bit different. And therefore, the makeup of your portfolio might look a little bit different.
So one question for you to shift just a little bit of things that we hear quite often, and you can attack it together because it certainly is a political conversation, or if you want to hit them separately. But coming into these elections, certainly we live in a polarized country. We've got quite a dichotomy between the right and the left right now and the way they see things going. And so as we come into that, is there a presidency that you feel the market would support in a greater way, or is it just different companies would do better under one versus another, and it just speaks to a little bit more of a tactical investment strategy to make sure you're capturing the ones that have some tailwind behind them? So the other side of that question is just the national debt. That's something that we often think about, and that is a political conversation, but I think a lot of us see debt as like a household debt. Like eventually, if you spend more than you make, that will lead to a giant collapse of your personal financial situation, whether it be a bankruptcy or whatever it might be. So how does that household view of debt translate to the national debt that we have? And is it something we should be concerned about?
Right. So let me take these in two different parts. So as it relates to the makeup of government, and again, so I want to highlight, and I understand, elections are emotional. They're visceral. We feel them. We get involved in them. And today's kind of environment is very close and it's very divisive. And we see it and we feel it and we're impassioned by it. Markets, on the other hand, it hasn't made all that much of an impact. So I want to kind of really separate those two things. So if it's been Republican president, Republican Senate, Republican House, or Democrat, or any mix thereof, at least as a goofy quant person, statistically, we cannot say one is, statistically significantly better than the other. They all tend to, on average, do pretty well from that perspective. So that's why we encourage investors not to overreact to election headlines or outcomes. Oh, my candidate didn't win. The world's going to heck. I need to raise cash. It's the biggest, I think it could be the biggest mistake investors make. So that there's that component of it. Now, what's interesting is I think there's some counterintuitive things that happen. So if I were to poll the audience, if we could poll them and say to them, which of the 11 economic sectors has done the best under a Biden administration, I think they'd be surprised to know that it's been energy, right? I think that's counterintuitive. Why is that? Well, Biden basically canceled the pipelines. He doesn't allow for drilling on federal lands. He's more climate kind of oriented. So the supply of oil has been constrained while the demand for oil remains high and the prices have gone up. That's benefited energy companies. I think, again, counterintuitively, the notion would be, well, if Trump gets in, this is going to be great for oil companies, right? He's going to restore the pipelines. He's going to allow drilling on federal lands. He's going to dismiss some of the more climate-oriented policies. That's going to be great. Well, what's going to happen is that's going to increase the supply and likely reduce the price of oil, which will reduce the company's earnings. So I kind of caution investors to think that there's some things at the margin that they should think about. But overall, stocks should do pretty well under either kind of whatever the end outcome, the makeup is. There is some things kind of at the margin that could be interesting from that standpoint. All right, let's go towards the deficit. So I mentioned how I was a little bit more concerned about kind of next year. So we are running a deficit that's about 7% of GDP. That's pretty high, about $2 trillion, at a time when our economy is expanding and our unemployment rate is very low. Again, Democrat, Republican, doesn't matter. It's irresponsible. And both parties have done it. And both presidents, Trump did it, Biden did it, their predecessors have done it. So what's happening is, because markets and real estate and everything else is up, the government is collecting more taxes. That's great. Revenues are increasing. So Brian, you mentioned almost like a household, right? If we were to think about this, revenues are increasing. That's great. Unfortunately, spending is increasing by a far greater amount. So a lot of the spending was to combat the negative effects of the pandemic, the CARES Act, that was a Trump thing, and then ultimately Infrastructure and Investment Jobs Act, CHIPS Act, Inflation Reduction Act, et cetera, the American Rescue Plan, things like that. So massive, massive spending from that. Now, for the last 35 years, we've been able to run these deficits because our interest costs have been falling. I mentioned earlier, throughout my entire 30-year career, bonds have been in a bull market as yields have fallen and bond prices have risen. That's no longer the case the last 3 years. And the average interest cost for debt for the government is just 3.3%, probably similar to your mortgage, but it's increased dramatically. And so these costs are now eating into more of the budget, and they can't continue to spend at this rate. So if you believe that all this fiscal stimulus, everyone's scratching their head, why did we not suffer a recession when the Fed aggressively raised rates? One of the reasons is because of the massive amount of fiscal stimulus. So we just borrowed growth from the future. So if you believe that it boosted growth and inflation in the future, if we're going to have to spend less as a result of kind of the massive spending, then ultimately the economy won't grow as fast. It will be disinflationary, which will be, helpful to some, but ultimately I think it will have an impact. So it is different because interest costs are rising, not falling, and the size of the deficit's bigger from that standpoint. Now, we know we have the exorbitant privilege of the US dollar. Fair, that allows us to run these deficits, but it's a privilege and it shouldn't be taken for granted. And my concern is that our government, Democrats, Republicans, and whatever else they want to call themselves, are taking it for granted. As a result, rates will be higher in the future. That'll slow economic growth and reduce asset values, kind of broadly speaking, across the board. So I think that is a risk kind of next year and into 2026.
So is the solution stop spending? I mean, do both parties need to kind of become more responsible, as you alluded to?
Yes. So Brian, here's the thing. So there's the solutions are not unknown. They just don't get you elected. So it is to reduce spending, government spending, and it's to raise taxes. And clearly, right, there's different ways to do that, right? So here, and again, not to inflame your audience, but right, so different people have different views, right? So broadly speaking, Democrats, Biden included, they want to tax wealthier people, right? They want to tax the high income earners. Republicans, they want to kind of keep lower taxes on corporations because they think that has trickle down effects, and do taxes in a different way. Ultimately, somebody's got to, the way some people call about it is eating the spinach. Somebody's going to eat the spinach. And so ultimately it needs to be a balance between reducing spending and raising taxes. That combination will help reduce the deficit, but it will slow economic growth. And ultimately it doesn't get any of these folks, again, Republican, Democrat, Independent, whatever you want to call yourself, elected. And therefore they're kind of short-sighted and reluctant to do it. So ultimately what happens is the market has to come in and do it for them. And the way that happens is through higher rates, through higher interest rates. And we've been chatting. Rates they're not high, but they're higher than they have been. And they've been more volatile than they have been. I think it's partly because of this kind of situation, this poor fiscal situation that we are now in.
And I think some of the reason why this causes so much anxiety for people is honestly, we have no control over this stuff, right? Like we can elect or basically put in our vote, cast our vote. But beyond that, we can't control in a large part the spending that happens in Washington. We can't control what the stock market's doing today or what it will do on Monday. And so coming back to that financial planning approach and that goals-based financial planning and that proactive tax plan approach as well, looking at Roth conversions right now, if you're a retiree, looking at, in-kind donations and qualified charitable distributions, anything that you can do to only pay your fair share of taxes and to position your taxable retirement plan in a way that that will reduce your overall risk to these possible increase in taxes in the future. And so I feel like, Mike, we could talk all day long. Like, I wish I was going golfing with you later today because we could just pick your brain while we're making birdies. But let's go ahead and cap it there. Do you have any final thoughts? Any other kind of overarching thoughts that you want to throw out?
So I think from my perspective, I really would like to just kind of end on that emphasis around that goals-based financial plan, that investment policy statement, the key ingredients of save, 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 where Dan started, keep taxes reasonable, costs reasonable, and not to overreact. In many ways, investors, including professional investors, like myself, their worst kind of thing is they're their own worst enemy when they fall to their behavioral kind of biases. And that's what creates mispricing and opportunity, in my humble opinion. I really think I love that message. And I think that that's a key message for today. And I really kind of want to kind of highlight that. Just going forward, I do think that, there's a little we've chatted about, oh boy, here are the risks, and they might be skewed to the downside. I do think that there's an increasing risk that the Federal Reserve keeps rates a bit higher for longer than necessary, and that pushes us into an unwanted recession. That's kind of the policy mistake that they often make. If you think about it, they waited a long time to address inflation because they wanted to make sure it was entrenched, and then they had to catch up. They're likely to wait too long for us to begin cutting rates, and will likely be in recession. It won't be the end of the world, as Brian was pointing out. These things happen. It's called the economic cycle. And it actually creates some opportunities to pick up some investments for bargain prices. But I want to say that there could be some reasons why this might not happen, including things like artificial intelligence. And again, I know that this is a very politically divisive issue, but immigration is another area where it's helped us reach a better equilibrium in some ways, particularly on lower service jobs and lower paying jobs, in terms of kind of helping with the inflation problem, with the labor kind of challenges that could help. So there's a number of structural things that I think are very positive for the US. And so again, keeping an eye on the long term, I'm very excited and I'm very optimistic around things like artificial intelligence and productivity gains and US exceptionalism. So I wouldn't want our discussion around risk to cloud anyone's judgment on the long-term kind of opportunities that exist. I think there's tremendous opportunities going forward. AI is just one of them that I think will help with economic growth, with operating efficiency, with our own personal lives, with helping businesses grow, that I'm really excited about. I'll just leave it with this one thing. Sorry, I know, obviously I like to talk. This one thing is, as it relates to artificial intelligence, Bill Gates says that he's got a quote that oftentimes when it comes to new technologies, folks overestimate what can be accomplished in a year. They're too optimistic, but they underestimate what can be accomplished in 10 years. That's how I feel about AI today, just to kind of sum it up there from that standpoint. So I think it's going to have meaningful changes on healthcare, insurance, consumption, and so many other things in a very positive way. But it's likely to take us a little while to get there.
Well, Mike, thanks so much for your expertise and the dedication you have to your career that we get to bask in as you give us your expertise. And so thank you for that. And again, I hope your tea time is yields many birdies for you over the weekend. And in your position as a father, I hope you get taken great care of this weekend. And there's really no better or more noble position that we all occupy than being a dad. So appreciate your efforts there. So a quick announcement, next month, our Elevánt Insights webinar is going to have another star-studded guest. So we have a professor from the American College of Financial Services, his name is Steve Parrish. He focuses on retirement income. And so he teaches many classes and even writes many of the courses in reference to how to generate retirement income and different ways to generate retirement income. And so we're going to have just an awesome conversation around that, and especially in today's market environment where income is a challenge. And so that'll be one that you'll definitely want to tune into. So July 15th, that's a Monday at noon, we'll have Steve Parrish with us. And so thanks so much for your time today, or for whatever moment you take to watch this webinar. We appreciate the trust that you extend in us. And as you can imagine, we devote all of our professional expertise to helping you be successful in your financial lives. And so thank you for that trust. And so we will plan on seeing you guys next month. Thanks for everyone for being with us today, and we'll talk to you again soon.
Thanks, Mike. Thanks, everybody, and happy Father's Day.